How are you doing, Johannes?
Hi, Jaime. You see,
Good.
that's the difference, right? We Germans, we freak out if at 6 o'clock it's not
I know, I
working.
know. We Spaniards, or at least some of us, also freak out. Apologies for the mistake with the link. With
No
Zoom, I guess
worries.
with Teams and Zoom, I admit that I am as technological as my grandma probably, but yeah, I feel fine in Meet, but I guess it's my thing too. But here we are.
Look, as long as we don't have to use Microsoft, I'm fine.
Exactly. I guess, in my opinion, they make 99% of their revenue just because they still have Excel. So I think, like, for many companies, it's like we will never leave because of Excel. But definitely the other products are not such a big fan. Absolutely. Anyway, so, well, let me wait a couple of minutes. I see people still in the waiting room joining. So maybe we can give it
Sure,
a couple of minutes to start.
sure.
So, by the way, will I see you in with some pretzels end of the month?
Yes, I'm gonna be there on Sunday and Monday. So I skipped the heavy drinking on Tuesday, but Sunday and Monday are gonna be there.
I guess. Yeah. I say it for us. Again, this is, I don't know if it's a Spanish thing, but for us, it's surprising that the event starts on Sunday, and I guess it's already like pretty active on Sunday, right? It's not like pre-event or anything like that, right?
Now, that's surprising for me as well, right? So I've never been to an event that starts on Sunday. So I don't know. Maybe, yeah, I don't know. I will ask Felix if I
Okay,
see him, why and how they decided to do so.
I see. It's Felix Haas, right? In 10x Founders, if I'm not wrong.
Exactly. Yeah.
Okay. Great. Well, I guess we're already 30, so I guess we can already get started. I see some familiar names in the participant list. So well, first of all, thank you very much, Johannes, and thank you very much also the other attendees. So I'll give a very brief intro. I guess it's our first webinar with like in English and with someone in Germany. So I think we expanded our target group, and I would like to give like a very 1 minute introduction on us, on the Startup CFO. So in the Startup CFO, we are a team of around 25 people. We must be right now, between Madrid and an office in Berlin that we opened recently this year. And our main business line is to offer fractional CFO services for early stage startups. So startups that they still don't need a financial director full time, they can count on us for like anything related to reporting, financial planning, any fundraising, obviously accounting and bookkeeping as well. So all of those services we can help with. So we're gonna be, by the way, I'm gonna be in Berlin by the end of the month, and then to the Pizza and Pretzels, as we were mentioning, like that's the beginning of the very last week of September, and happy to meet anyone that may be around. I'll give you also a bit of context at the very end on our academy courses. That it's an initiative in which we have two courses, one of them dedicated to venture capital and the other one dedicated to startup finance. It's a 2 10-week courses on that will start at the end of September on startup finance, venture capital, online courses that we have already done many editions in the past. So I'll give a bit of information about it at the end of the meeting too. Anyway, so Johannes, your life is way more interesting than mine. So before we...
It's what you say.
I mean, I guess I'll prove the point. So before we jump into the topic of the European VC, what to expect from the European VCs in the second half of 23 and 2024, a bit about you. Like, as in a job interview, tell me your life up to ProductUp, more or less.
Yeah, sure. Happy to do so. Johannes, I always have to think, I turned 44 this year, right? So from a background, I studied management in Paris, Oxford, and Berlin, then did 3.5 years in consulting before starting my first company in 2008. So that's already 15 years ago, right? And since then, fortunately enough, I'm building successfully most of the time companies and selling them, right? So I did 2 marketing technology companies that I sold to the largest publishing house in Germany. And what kept me busy for a little bit more than 10 years until 1.5 years ago is ProductUp. software as a service company that I started together with my technical co-founder. And yeah, as it always is, when you start, you're two people, right? And we managed to grow the company up till now to roughly 400 people, 35 million in ARR. And
How much
I
ARR,
did
you said?
35 million. So 35 international clients like Apple, Walmart, Walgreens. And I did that so 1.5 years ago, right? Because I think as a CEO of a company, always the question that you have to ask yourself is, am I still the right person to run the company? And I would say, given the numbers and the metrics and the happiness score of the employees, I would say it's fair enough to assume that I could answer that question with yes. But at the same time, I realized I was not happy anymore doing the job, right? So I wanted to be a little bit more early stage, evaluating hypotheses and so on. So I think that's why I left. And since then, again, started two companies, but not in an operational role, but rather as a coach and mentor on a sideline, and started to again invest more heavily into early stage companies. Have built a kind of portfolio of 35 active companies at the moment, and did in total 50 investments. Yeah, and trying to get like an entrepreneur, right? Trying to get better at it every day.
We try to remove the uncertainty. Okay, so dividing your life in these 3 stages that we were mentioning. So in terms of before production, well, how were these experiences as consultants? And also this, I saw on your LinkedIn, this first entrepreneur experience before ProductUp.
Yeah. I think, I mean, that's my personal view, right? So I think being an employee versus being somebody who starts a company, right? So it's just, there's no difference in terms of what is better or what is not, right? It's just a question, what is suited for you and which type are you? And I think deep down, I always aspired to be an entrepreneur, right? So I think I grew up in a family where there was not a lot of money. So my parents were fairly young. And I started to do, I would say, businesses already as a young kid, right? So the first business I remember is, I don't know if you guys know Kinder Surprise, right? So those little eggs where you have those figures inside. So my first business was to go in the local grocery store and weighing those eggs, because I knew that the ones with the figures inside would weigh 0.1 grams more than the ones without it. So I would weigh them, figure out which one had a figure in them, and then sell it for roughly 3 times the price that I purchased it. So that, I would say, was my first business.
Wow, not bad. Okay, first entrepreneurial experience. I guess there are many, but
yeah, and I think then I continued to do stuff like it. And I think then with my first company was the first experience with having investors on board, right? Which again changes everything. So even though having a management education, having been in a consultancy for 3.5 years, it doesn't prepare you for the life of being an entrepreneur, right? So I think at one point you just have to jump into it and see what happens. And in hindsight, I would say I was ill prepared, but luckily enough, I survived and was able to, build on that experience and successfully built businesses thereafter. So also the first business was not it was not a huge success, but also not a failure, right? So I was able to lead it into a situation where we did a strategic collaboration with Hewlett Packard. The investors got their money back, and we made some money, but not the foreverly happy after money. So I think it was a good learning experience.
Mm-hmm. I see, and definitely like paved the way for ProductUp then. And then in ProductUp, I guess like many people like in the audience here from past editions of Academy and stuff are in the management team or in the founding team of early stage startups. But then I guess not so many have seen the whole path until like 10 years later, 36 million ARR and stuff like that. So how do you say it changes like the company and your role in it stage by stage in all that process?
Look, I mean, that's always a question also in terms of how do you personally define your role as a CEO, right? But I think in terms of stages, it's for me, it's one stage where you're up to 35, 50 people, that it feels like a tribe, right? So it's a family. Everybody knows everything. Everybody knows how the company is running. What are you doing? So it's really, yeah, like a family. I think that's the best description I would have. And then once you surpass a certain number, and it of course varies from company to company, but I would say around the 75, 100 people mark, you realize, shit, there's something called processes that we need right now, right? Because you onboard more people, not everybody knows everything anymore, not everybody knows everybody, right? So I think it's a cultural change where you realize now we need to prepare the company for additional growth. And that growth can only efficiently happen if we have processes and structures in place, right? So basically you start off scaling the company, testing hypotheses, and you're fine without processes, right? So your main differentiating factor is your speed and your ability to test hypotheses and things fairly quickly. And then once you tested those hypotheses and you found a go-to-market, you found your initial buyer profile, then what you need is scale, right? And in order to scale, you need processes and structures. And then basically it's, again, like an early stage company, you start off with zero processes, zero structure, and you have to build that, right? And then, yeah, thereafter, I would say from 100 to 300 people, it's just finding the best ways to repeatedly do the same things, right? Selling more, building better structure, getting on board more people. So I think it's then, again, testing those structures and then those processes and refining them in order to become more efficient as a company. Yeah, I think that's the way I would phrase it. And I think as the role of a CEO, for me at least, was always, I mean, first of all, you have to make sure there's enough money in the bank to pay the people, right? So that is your number one job, I would say. And the second job is to find the best people to join you on the journey and make sure that they're knowing what they're joining and that they are basically in the best position to fully contribute to that journey. And then thirdly, it's retaining those people, right? So I think it's not only about finding those people and being able to recruit them, but also retain them, right? So, and that especially becomes, again, more of a topic when you grow larger as an organization. Then there are questions like, look, what is the individual development plans? So what is basically the future that we can offer somebody that's already 5 years with the company? So where do they will develop into? Is it a managerial role? Is it an individual contributor at a senior level? What is the motivation of each individual? And how do I maintain that spirit of being a family of 35 people, right? So I think those would be, for me, the three main criteria, which, I mean, they shift in terms of importance per stage, but it's always, you may need to make sure that you have enough money, you find great talent, and you motivate and keep that talent.
I see. And then more near the moment that you decided to leave, I admire CEOs that are able to say like, okay, I'm done, or like, I'm not the best person, or I am, but I shouldn't be anymore. I guess it was a difficult personal decision, I bet. So what was like the drivers and how was like the process and afterwards?
Yeah, look, I think it's a gradual process, right? So I think when, like I described again, so when you're at 35 people, it feels like a family and it's hard to leave your family, right? But if you're 300 people and you have that well-oiled machine that works independently of you, and it's kind of, you come in and check, is it enough oil? Does it have enough electricity to run or whatever it is, right? So it's more independent of you anyways, right? And so I think it was really that point where I realized for myself, I don't enjoy my job that much anymore, right? And then I think the way I always run the company is I try to do it without ego, right? So I wouldn't have a problem to do a different job within the organization. But again, as a CEO, that's a hard thing to do, right? So I think that wouldn't be fair against the person taking over your job, because then you've worked with people for, let's say, 8, 9, 10 years, and then somebody else has taken over and you take, I don't know, a role in second management or whatsoever. I think then you create that shadow organization, because people natural, they come to you, right? They speak to you because they have been doing so for the last 10 years. And I think for me, what I've always done is I separated personal life and work life. So we built a great company with really cool people, and it would have been easy for me to be friends with everybody, right? Because they're just amazing people. But what I did on purpose is always kept a certain distance between people working in the organization and myself. Not because, again, I would say, look, I'm cooler or whatever, better, but really to be in a position to call the difficult shots in case I would need to do so. And I think also that made it easier for me to leave at one point, because it was clear that me as a human being, individual, is not the company, right? So it's detached. And I think to some extent, I understand if you work 16, 18 hours, to some degree, you become the company, right? But I try to keep that distance, right? Because also there, if you're successful, that's fine. But if you fail with your company, then if you're too entangled with it, then you feel like you failed as a person, which is not the case, right? So it's something different. And I think I always kept that psychological distance. And therefore, it was easier for me to leave at one point, where I realized, hey, it's just not the thing I like to do. And then if you realize that, the logical explanation is as well, if you're not really keen on doing what you're doing, then somebody else is going to do your job better. Right? Mm-hmm. Because there are people who really like that challenge, say, look, it's 35 million in revenue right now. It's 300 people. That's for me exactly the sweet spot. I want to grow it to 50 and 100 million in ARR. I want to grow it to 500, 700 people. And it's just not better or worse. It's just a different skill set. And it's like, some people enjoy playing tennis. Some people enjoy playing soccer. It's just a different sport, right? Mm-hmm.
I see. Yeah, I always admired Jeff Bezos being the right guy when the company was one person, when the company is 2 million people. But yeah, he needs to like all the jobs. I hope he does. Yeah, absolutely. So then I saw that, as you were mentioning, you switched your role to much more as an investor. So before going into the future, speaking a little more about the present and the recent past, I was seeing in your LinkedIn that you are also limited partner in several venture funds, and that you have been doing it throughout all these last years. So did you take into account the VC cycle, the economic downturn at all, or you were just thinking like, this is the right fund to invest in? How do you factor those two?
Look, and to be perfectly honest there, I think before I left ProductUp, I was doing angel investing on the side, right? So running a company of 300 plus people and then trying to find the best investments is a tough cookie, right? So, and then like everything, I think if you want to do it to a certain degree of perfection, it demands resources and energy of you, right? And then I realized at some points, angel investing is really a lot of work, right? And then I had those phases where I had too much to do as a CEO, and I thought like, okay, maybe I give the money to venture capitalists, to funds, right? And they do the job for me. And then I think later on in the cycle, I looked at the performance of the venture funds and I looked at my own performance and I thought, maybe it's worth investing more energy and resources into my own investment arm, right? And I think that is the journey, how it happened. And my philosophy, and I think data shows that this is fair to assume, as I predominantly invest in early stage, in first time funds, right? So when they set up the fund, and my logic there is that, I mean, I like the business rule of alignment of interest, right? So what I always ask myself is there alignment of interest, yes or no? And I think for venture capital, if you put money into a fund, the biggest alignment of interest is in the first fund. Because there, if people fail with the first fund, there's not going to be a second generation, right? And that is my logic in mostly investing in first-time funds. And sometimes it's a little bit less strategic, right? So, for example, investment in something like the World Fund that's then driven by the cause. I think they're going to realize good returns, but I think that's also a way of giving back, right? So at one point, it's not only about the money that you earn. I think there's good investment opportunities from a financial perspective in, I don't know, if you invest in weapons, if you invest in gambling and so on, but I wouldn't do that because I have also, let's say, a personal set of rules and things that I want to support or not, right?
Mm-hmm. Makes sense. And in a sentence, also, like, you have seen many VC like stages in terms of like the cycle, like boom, busts and stuff. What would you say is the current state of European VC right now, like for the second half of 2023?
So if I would summarize it in one word, I would say it's slow, right? So it's slow. So I think there's less deals take longer, right? So there's less volume in terms of capital deployed. So it's really cooling down compared to 2021 and 2022. But if you look at a longer period of time, you have to admit that 2021 and 2022 have been exceptional years, right? So for me, if you look at the headlines, it's a lot about, is that a VC crisis or what is happening here, right? So I think I wouldn't describe it as a crisis. I would say it's rather going back to normal levels, right? So in 2023, we are at 2020 level, right? So, and it's not completely that nothing is happening. It's just not the crazy stuff that we saw in 2021 and 2022.
And what market do you think creates more value, all in all, or it's better in general for investors and entrepreneurs?
You mean what market in terms of geography, or?
No, in terms of like the boom and the bust, like, was it better 2021 or like or let's keep it rational like that?
Look, I would say in the long run, this is now a good time to invest in, right? And I think it really depends on your investment horizon, right? And the behavior. So for me, nothing changed in terms of my investment approach. I was not investing more in 2021 and 2022, and I'm not investing less now in 2023, right? So if you look at a company in itself, the company is not better or worse if it's all the same, if the market environments change, right? So I think for me right now, if you look at the data, it's the most investor-friendly investment ecosystem for the last decade, right? So which means in the end that good companies you should be able to invest in at lower valuations, which when they exit, maybe in 5, 6, 7, 8 years, then you're going to realize better returns compared to having invested in such a company in 2021 or 2022. If you're there for realizing short-term gains, I think that's not the market right now, right? So I think in 2021 or 2022, you could have invested in a company like 2020 and then sold at 10x in a secondary in 2021, right? And I think that is not sustainable. That's not long-term oriented, right? So from the funds I'm invested in, I know, for example, one deal a global investment firm, they invested at a valuation of 100x ARR, so 100 times revenue. And I always ask myself, please show me the fund model that calculates a return that is able to return the fund on that investment, right? So, and I think that shows that some of the investments that have been made in those years were just not good investments, right?
Mm-hmm. Makes sense. And what about the balance between seed stage, early growth stage? Do you think that it has changed through the last years and it will change in the coming years?
Yeah, so I think I mean, what I expect, right? And it's a little bit like looking in a crystal ball, right? So it's my personal opinion based on the limited data that I have, is you saw decline in all three categories, right? And seed stage being the less impacted. So what I would expect for maybe late 23, maybe 24 is that compared to seed stage, that the other two stages will see a steeper increase because simply companies in those stages, because of their bigger maturity, they're able to manage things differently, right? Maybe they do a bridge round internally. Maybe they sit on a cash cushion and they just extend runway, like we saw with a lot of growth stage companies, that they fire people, right, to extend runway. And I think then if they grow into the metrics that they need in order to raise the next round, we're going to see more activity in 24 in those two stages compared to seed stage, right? So I think relatively stable development in seed stage, whereas the other ones, maybe it's end of 23, maybe it's in 24, we'll see an acceleration, but not necessarily because there are more opportunities, but rather because they postponed rounds now in 2023 because they say, look, valuation is not good at the moment. If we have the capability, we do an internal round, we extend runway by doing some measures and then raise if the ecosystem is again more favorable, right?
I see. What about a similar analysis for the venture capital funds themselves? Like if a fund was raised during 2020, 2021, right now they are during their investment period and they have the money in the bank. So, yeah. I mean, maybe they are like, okay, it's lower on releasing it, but they are going to release it in the more or less same period of time. So on that, would you expect also like a bit delayed crisis because now there are no new funds being raised? On this, I trust your judgment 1,000 times more than I trust mine. So,
look, I think also there, like with the startups, right? So I think the good companies, they will get money independently of the market environment, right? And I think the same happens with the good investment, with the good VCs, right? So if somebody like Sequoia raises a new fund, they will not have a problem raising the money, right? That's at least what I assume, right? Somebody like Tiger Global, will they raise a new fund? Probably not, right? Or if they do, they'll have problems doing that. And I'm not saying, I mean, I'm not judging their work. It's just like, I would say what the market is expecting, right? And I think and I always do that argument, right? Like you do, there's a lot of dry powder, so people will invest it. But I think what will change, or what we have seen has changed, is there's a lot more focus of the VCs on portfolio work, right? Whereas in the past, it was like, I do a deal and then the company, I'll push them and then somebody else takes over, right? Because they do the next round and the next big investor comes in, they take the board seat, they take the control, and they're basically the ones holding the hands of the founders and supporting them. And I think because of the next round is not happening, VCs are actually forced to take care of their portfolio, right? And it maybe do a bridge round, maybe allocate more capital than initially planned into a single asset. And I think that's what is happening at the moment. And for, let's say, the ability of funds to raise further capital, for that to kind of make an impact on the market, I think the cycles are just too long there, right? there's a lot of stuff that can happen in between, right? Because I mean, what is happening if you go back to my argument of I invest in first-time funds. So I invest in a fund, and then, for example, one company I invested in their first fund, it's now the 7th year, and they have raised 2 additional funds since then. And that has happened without knowing the performance of the first fund, right? There is no DPI yet of the first fund. So you can say, yeah, if you look at the money on invested capital, that fund looks good, but are you going to return those euros to your investors? Not sure yet, right? Probably yes, but I think that is some part of the game in VC. It's really a long time until you know how somebody performed, right? And I think that is a little bit also one of the caveats of the industry, because when you go back to my comment about alignment of interest, I think at some point when the VCs get bigger and bigger and bigger, and they raise, I don't know, 100 million fund, and then 200 and then 500 million, I think to some extent, again, that's my personal view, there's no longer alignment of interest between you as an LP and the fund manager, because if you raise a 500 million fund and you have a 2% management fee and you do the fund for 10 years, then you're basically getting 100 million management fee. So that's not too bad, right? So then, of course, basically the carry can come in as a kicker, and if you do great investments, that's easily more than 100 million, but basically there's no downside anymore, right?
I agree. Yeah. I have done those numbers before in my head. That's why I want to be a GP one day.
Yeah. But then again, the question is, do you really want to be somebody where there's no alignment of interest between the people that give you money and yourself as a GP, right? Because, and I cannot totally understand it as somebody that has been building businesses, right? But I think there's then a deviation, and the deviation is the job of a venture capitalist should be to realize maximum returns for the LPs. But if your fund generations become bigger and bigger and bigger, you're basically in the business of raising funds, which is different, right? And then you do marketing deals, and marketing deals are, hey, I needed to show that I can do a competitive deal. I needed to show that I can do a cross-border deal. I needed to show that I can get into a competitive round. I needed to do a B2B SaaS deal, whatever it is, right? And then you do deals to convince new LPs to join the next fund generation, instead of doing deals for optimizing return for your LPs.
I see.
I'm not saying everybody does that, but I think there's at least a tendency with growing fund size.
Yeah, or the temptation.
Exactly, yeah.
So regarding that as well, like the dynamics between startups and VCs. So now with less money has been in the market, has become from more collaborative between VCs to more competitive, because now the best deals have more funds looking into them.
Yeah, I would say so, right? So I think it has become more competitive. Also, people being more flexible on stages, right? So if somebody says, look, we typically do Series A, maybe they do a little bit earlier in order to get a foot into the door, right? And same happens with Series B, then looking at Series A and so on. So I think for the good deals, right, only in hindsight you will know if it was a good deal, yes or no. But I think there's increased competition. Yeah. So for me, it happened for the first time in 8 years that I'm investing right now, that this year I wanted to get into a deal and I was not able to sign a check. They just said, thank you for your interest, but and I take some comfort in that they also declined Sequoia, but again, that happened for the first time in 8 years.
Yeah, I think I would always want to be on the side of Sequoia, for good or for bad. Absolutely. So, well, by the way, if there's any question, like we are 40 people here, if there's any question, feel free to write it on the chat, even to unmute or to use the function of raise hand. I have here like a list of things, but happy to derail if anyone wants to ask anything in particular. If not, we keep going, but again, feel free to write it in the chat or anywhere. Regarding industries or particular sectors, so we hear now like AI all over the place, but what do you think in general about AI and in general sectors that you think are bullish for the coming years or bearish?
Yeah, so I think definitely bearish. I think that's easier. So I think e-commerce with physical products is going to have a hard time, right? Because people understand now that if you even if you're successful and you're growing, because of the working capital requirements, you will need more money, right? So I think that is a sector I would say is probably not that in anymore. I think AI, yes, definitely, and it also makes sense, right? Despite the hype, I think the technology in itself and the revolution that we see there is one that we probably underestimate in the long run, right? So I think if you look at the US, then 50% of all investment in Series B rounds went into artificial intelligence in 2022. And that totally makes sense for me, right? So, and I think then one thing that I think also makes sense is that we see more and more, let's say, investment into clean tech and energy. I think that's also a trend that we see that totally makes sense. And I think then one thing that I personally think of, which is maybe a little bit underestimated in the public domain, is everything around efficiency, right? So if you look at the internal efficiency of companies, now that we know the economic conditions, interest rates are rising, inflation is rising, and consumer spend is rather declining, then even if you're an established company, what becomes more and more important is that you as an organization act efficiently, right? And I think tools, software, technology that you as a small, medium-sized or big organization can help you to be capital efficient and efficient. I think that's also a sector which is going to get more attention over the upcoming years.
I see. But I guess it would be easy to argue as well, like if you said half of the American VC money, right, went to AI.
In Series B funding, right? So at a certain stage.
Okay, then I guess it makes more sense. I was thinking like it kind of sounds as bubble as well, or like it could, like the argument could be made also like, okay, maybe we're putting a little too much, and in a couple of years we'll forget about it. But like, is it valid investment, do you think?
I mean, it depends, right? So I think it is. I mean, your job as a VC is to find that one company which can return your fund, right? Mm-hmm. And I think that AI as a technology in itself has that potential, right? So I think it's fair to place a bet, right? Because that's what VCs do. It's venture capital, right? So 90% or maybe less, maybe for some funds more, of the companies, they're going to fail or they're going to return insignificant returns for your fund. But you need to find that one company that does the 10, the 100x, right? And I think AI in itself has the potential and maybe bigger potential than other industry to deliver that one company, right? So I think when I think about it is, and I mean, I personally played around with all the tools which are out there, which are consumer facing, right? So the Mid-Journeys and the ChatGPTs and so on. But I think to give you one example is there's a company called Blinkist, right? And they do short excerpts from books. So they've been sold for 100 million plus to an Australian publisher. That business in 5 years, it's not worth anything in my point of view, right? Maybe because you have those users, you have the people who subscribe, but everybody can now go to ChatGPT and ask them for a 2-page summary of a book.
Absolutely. In terms of technology, obviously you know much more than me. What about blockchain? The couple of years, like this reminds me like a couple or 3 years ago was the hype. What do you think by now and in the future?
Look, I think the one thing is that where we have to distinguish is between the underlying technology and blockchain and smart contracts, and then what catches the public eye, right? So I think what we have been seeing is the Sorares of the world and the NFTs, right? The CryptoPunks and the Bored Apes. So I think that is what has caught the attention of people and what they link to blockchain as a technology. But if you think about smart contracts and the fields of application, I think it's pretty useful, right? And it's that hype cycle. So it gets hyped and then again, it falls down, and then useful applications are developed on the back of that technology. So I'll think in the long run, there's going to be a lot of applications based on blockchain, but are we going to see another NFT hype? No, probably not, right?
I see. Perfect. So we have covered stage, we have covered industry or vertical or technology. What about geographies? Any particular markets or regions that you would bet more on or less on?
Look, I think that's the access to deal flow as well, right? So I think 60 to 70% of my deal flow is from the Dutch-speaking region. That's just where I have my network. But I think, I mean, the stuff that I like to look at is basically small markets where people think more international, right? So in Germany, you have that dilemma of being stuck in the middle. You can build a decent sized company within the local market. If you look at the Netherlands, if you look at the Nordic countries like Finland, Sweden, or also Eastern European, then they from the start think international because their home market is just too small. If you're Danish and you have a couple of million people, you cannot build a sizable company, right? So then you have to think in an international. So I think that is something that I would look at is, are there solutions which think international from the start? That's what I did for ProductUp as well, right? So when we had the first working solution of our product, I would jump on a plane, fly to the US and try to find partners there because I thought, why should we always buy US technology? Why couldn't it be the other way around? And it worked, right? So we struck a partnership with Adobe that didn't work out, but we struck a partnership with other stock listed company. And for the first 2.5, 3 years, they have been the best selling partner and have been the single biggest revenue contributor.
Oh, yeah, a good one there, a winner, definitely. And what about traditional versus non-traditional tech hubs? Like, I guess it used to be Berlin, Paris, London. Like, do you think like cities, which ones are the best? What about like companies that are from the middle of nowhere? Like, what do you think?
Look, honestly, I think it doesn't matter, right? So I think now, sorry?
Yeah, in terms of talent to find?
Yeah, but I think so the question again is, as a VC, it's not about the average, right? As a VC, it's about finding that one deal, right? And if you find an exceptional team that has really great traction and they come from the middle of nowhere, are you going to really tell them, look, I'm not going to invest if you're not moving to Berlin or London or Paris? No, I wouldn't, right? So I think there are advantages of the ecosystem in terms of being closer, being connected, things going quicker. But again, having a great team and having a great idea, having great execution beats location always, right? And so therefore, I think, yes, there are advantages, but at the same time, the ecosystems, even if they are developing, they're not the Silicon Valley, right? So we started 30 years later. And I think they are European hubs, right? So where, I don't know, London, if you go for London, London is probably good for raising the next financing round, right? Because there's a lot of money in the city. And then Paris is good for something else. Berlin is good for something else. So I think you have to think internationally and also distribute it. But I think that's also comes down to a personal philosophy. My philosophy always is, I don't care where somebody works from. If I'm afraid because they don't work from the office, I hired the wrong people. And also having everybody in the office and then assuming that you can control them is, for me, is a myth, right? Because even if somebody's 8 hours in the office, they can be non-productive for 6 hours standing around a coffee machine. How can I control it? So if I feel that urge of controlling somebody, I think it's the wrong setup. And I think that's the same with investing in founders and investing in a company, right? So if you trust them to do remote work, then yeah. I just invested recently in a company that's 100% remote. They don't even have an office.
Yeah. So yeah, in terms of talent, they actually can hire the best anywhere. So pretty good.
They can hire the best, and I think my assumption is that people are going to stick longer with them because they have the flexibility to work from anywhere.
Absolutely.
And again, it comes down, if we now agree on a salary, right, and you're in Spain and I in Germany, if you are now able to take the same salary and work from Thailand, basically your buying power is completely different, right?
Totally. See, there's a question from one participant. So what are your requirements for making a seed investment? Summary of your investment thesis.
Look, the thing is, I'm super, let's say, optimistic, and I'm easily excited. So therefore, what I've done is I hired somebody to support me as a venture partner. And what we do is we always go through the same catalog and we write an internal investment memo where we always look at the same criteria, right? And then if all those criteria match, then we're going to do a seed investment, right? And I think from my development has been, as an angel investor, I would say, great team, great idea, I'll put some chips on it, right? And then if you do that, let's say, more professionally, I think there are more criteria that you need to apply. And those criteria are, is the market big enough, right? So can it develop into a really sizable company? Then this next question is, how experienced are the founders with fundraising, right? Because most of the time, that's a criteria for you to survive, that people are able to raise funds, right? And even if the early stage investors, they might be able to bridge, it's one point for additional growth, you need an additional investor, right? So those are two of the criteria. Then we look at the possible exit size, right? So is it a company that can be sold at some point? Because as a venture capitalist, you're not into the game for dividends. You want to sell the company at one point, right? And also there needs to be an exit market for that company, right? So, and I think that's kind of some of the criteria that we look at, besides more traditional things like what is the team, right? So how's the cap table structured? And basically, is there already traction? What is the validation? And what is the competitive advantage that people have with their solution, right? Because I think that is the most common mistake I see with founders, is not spending enough time on the competition, right? So, and I exaggerate here, right? So I think when you start off, let's say, as a scooter company, then you would define your market as competition, which is other scooter companies, right? And I think that is a definition which is too narrow, because the underlying requirement people have is transportation from A to B. So you can walk, you can take a bike, you can take a car, you can take an Uber, you can take a taxi, you can take public transportation. And I think that is also, whilst saying that, right? So I think competition is one of the areas where people don't spend enough time. At the same time, and excuse my French there, the competitive slide that you see in all the decks is bullshit. You can rip it off, right? So that quadrant where you see it's 4 corners and you're always top right. I never look at that slide, right? So it's always the same. Or you can have versions of that with you have certain criteria. For you, everything is with a green tick, and then the competition is with some red cross marks. It's not helping.
I see. We have another question. Do you think VC verticalization or specialization to seek differentiation is going to become more common?
I think it's needed, right? So one of the main, let's say, criteria or the criticisms that I have around VC is the question of what is your competitive advantage as a VC? You as a startup, you always have to speak about your competitive advantage. What is your competitive advantage as a VC? And I think not a lot of VCs are really differentiated in that regard. So even though verticalization and specialization on a certain sector doesn't provide you a competitive edge, it makes sense to develop that competitive edge, right? If somebody starts a fund right now and says, look, I'm only going to focus on B2B software, it's not a competitive advantage. It's a focus. And maybe due to that focus, you're going to be able to get higher quality deal flow, which then can become a competitive advantage. But I think, it's needed also because of the fact that you as entrepreneurs, you should get support from your VC. So I don't invest in stuff that I don't understand, even if I think that's a great monetary outcome, because simply I'm not able to help. And especially if you invest in early stage rounds, you should be able to support and not only provide money.
I see. Makes sense. Well, happy to receive any other question. We have some minutes left, but in the meantime, if anyone writes anything, you mentioned before something I like, that our difference between Europe and United States or Silicon Valley and stuff. Because I went there this summer, so but I think like you spent a lot of time there, and ProductUp you were between the two places. So how would you summarize the difference?
I think, so for me, people in the US are more open, right? So I never experienced that I reached out to somebody and asked them for something and I wouldn't reply, right? So I think it's rather that spirit of supporting each other, and entrepreneurship, I would say, is generally perceived as something being cool. Whereas in Europe, or especially in Germany, I would say, is if you're an entrepreneur and you're successful, then you're the capitalist, right? Which earns money on the back of its employees. And if it doesn't work out, people say, yeah, I told you so. Right? So I think it's a less supportive culture. Whereas at the same time, people in the US are less committed, right? So they tell you yes, but I think it's harder than to take that as a definitive yes, right? So I think there are pros and cons, but in general, I think, I mean, when I first arrived into the US, I had that feeling that everything is just bigger, right? And maybe faster. But now the last times I've been there, I think, I mean, that's my personal perception. You could see that maybe the golden days are also over, right? So there's a lot of things. If you look behind the curtain, things don't look as golden and shiny as they used to.
I see. Yeah, that makes sense. All right, so I wanted to take these last 2 minutes just briefly to talk about the 2 courses that we're launching at the end of this month. Well, by the way, in any case, if someone wants to meet us in Bits and Pretzels in Munich at the end of the month, we'll be there. I hope to see you in person, Johannes, in the end. And also, I'll be in Berlin next week too, so happy to meet anyone in Germany. But yeah, regarding our courses, let me share screen quickly. So we have So we have the course on startup finance starting at the end of this month. So it starts at the end of the month. It finishes around Christmas. It's only in English and only online. And you guys here will learn, well, if you've seen the website, we have had like 6 editions already, 350 students. And then also we cover topics on how to get funding for a startup, private funding, alternative funding, all kinds. Also business models, details on introduction to venture capital and stuff. And on our venture capital course, it's similar, but to learn everything regarding venture capital, so how venture capital fund works. We have done it, by the way, with the help of venture capital professionals that will give the lessons. In fact, I saw some of the teachers connected to this webinar. So if you guys are interested, just check it online or text us to my email or academy@tscfo.com. And happy to have like a new edition with a more international community. So, well, thank you very much, Johannes. I don't want to take a minute more after 7 from your time. And again, thank you very much for spending this time with us, and hope to see you soon.
Thanks for having me. Have a great evening, everybody. Thanks for listening.
Thanks to you. Bye.